In the dynamic landscape of investment, billionaires like Ray Dalio provide intriguing insights into where to strategically position one's money during challenging economic times. Wealth accumulation strategies and diverse avenues that transcend traditional options are needed. Beyond the realm of stocks and equity funds, individuals who embrace real estate, valuable collectibles, gold, cash equivalents, and private equity acknowledge the value of diversification and capital preservation. These strategies of the wealthy often hold intriguing insights into wealth preservation and growth. But what unique advantages do billionaires like Ray Dalio wield in these ventures? And what wisdom can we extract to navigate the labyrinth of financial decisions that shape our fiscal destinies on a more mundane level? Hello, and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we start, make sure to leave a like, subscribe, and comment below if you enjoyed watching this video, and turn on the notification bell to keep posted. And now, without further ado, let's start. First, stocks and equity funds. A shared trait among billionaires like Warren Buffett, Daniel Loeb, Ray Dalio, and Carl Icahn is their wealth accumulation through the stock market. Despite the general notion that stocks are not always the most dependable choice, these billionaires have remarkably thrived in this domain. Unsurprisingly, most billionaires allocate their resources to the stock market, often embracing companies akin to those found in the portfolios of regular investors. Their holdings span various sectors, encompassing energy, technology, and more. However, the notable distinction lies in the scale of their investments. These billionaires grasp the significance of stable, dependable stocks that grow consistently and, in certain instances, offer substantial dividends. Nonetheless, being a billionaire provides distinct advantages in the realm of investment. Access to extensive information and analysis empowers them to discover unpopular assets and take risky ventures compared to established blue-chip corporations. They possess the means to engage in initial public offerings, up-and-coming markets, and startups, often surpassing the capacity of other investors. Consider the case of Warren Buffett's Berkshire Hathaway, which boasts a significant stake in BYD, China's premier electric vehicle enterprise. This example outlines how billionaires wield their resources to engage in unique investment opportunities, leveraging their access to information and resources to create diversified portfolios catering to their financial goals. Second, real estate. Andrew Carnegie, a prominent figure in business history, once asserted that most of the world's millionaires had attributed their wealth to real estate. The enduring appeal of real estate is exemplified by numerous self-made billionaires, including Donald Bren, Neil Bloom, and Leonard Stern, who have gained substantial fortunes. According to Forbes, real estate mogul Donald Bren has a net worth of $17.4 billion, positioning him as the wealthiest real estate magnate in the United States. Bren's brainchild, the Irvine Company, presides over an extensive real estate portfolio spanning 129 million square feet, predominantly situated in Southern California. His holdings encompass approximately 124 residential complexes and an equivalent number of office buildings. Remarkably, Bren also owns 97% of the iconic MetLife building in New York City. Similarly, Leonard Stern, a billionaire with a strategic focus on industrial real estate, has reaped substantial gains through the growth of industrial assets. Leonard Stern's trajectory started in 1959 after joining his father's business selling pet supplies. Transitioning to real estate in 1966, he made a pivotal move by acquiring a warehouse in New Jersey. His enterprise, Hart's Mountain, owns over 260 real estate holdings in New Jersey. The company's portfolio is dominated by warehouse assets, spanning locations such as New Jersey, Atlanta, Baltimore, and Charlotte, North Carolina. Third, fine arts and valuable collectibles. In addition to real estate, billionaires channel their investments into an array of financial assets, including priceless artworks, sculptures, and more, both for financial gain and personal appreciation. While many of the elite share a genuine passion for art, others recognize the unique investment potential that art offers. Art investment holds a distinct allure for billionaires, stemming from its capacity to yield substantial returns and introduce diversification to their portfolios. In contrast with conventional investments like stocks and bonds, art presents a tangible asset that operates independently from financial markets, thus mitigating risk. Moreover, the art market has consistently demonstrated profitability, with masterpieces often fetching millions at auctions. Prominent private collectors such as David Geffen, with a net worth of $7.7 billion, curate galleries that rival small museums. Notably, Geffen holds the most extensive private art collection in the United States and ranks second globally. Billionaires also diversify their portfolios into valuable collectibles such as vintage and rare cars, books, jewelry, and intellectual property. A striking example is Michael Dell, the visionary behind Dell Computers, who treasures a prized collection of vintage photographs. Similarly, Jeff Bezos, Amazon founder, retrieved artifacts from the ocean floor, including components of Apollo 11's booster rockets and numerous NASA relics. Fourth, gold. Throughout history, gold and other valuable metals have maintained their allure among the affluent. From ancient Egyptian rulers to the modern elite, gold has consistently symbolized influence and prosperity. This enduring sentiment remains relevant in our era, as several of the world's most affluent, which includes John Paulson, Lord Jacob Rothschild, Ray Dalio, and Naguib Sawiris, actively participate in gold trading, recognizing its significance within their investment portfolios. Billionaires are drawn to these precious metals due to their dual role as a secure avenue for wealth accumulation and a steadfast preserver of value. During economic uncertainty or market turbulence, gold often retains or even appreciates its value, providing a shielded refuge for investors. Ray Dalio, renowned for establishing Bridgewater Associates, the globe's largest hedge fund by significant margin, strongly advocates for the merits of gold. Likewise, Lord Jacob Rothschild, a distinguished member of the Rothschild banking lineage, favors gold over the US dollar. This preference arises from a centuries-old Rothschild tradition of procuring gold, with historical roots dating back more than 2 centuries, including their contribution to Napoleon's defeat. In 2016, the Rothschilds substantially reduced their US dollar holdings, reallocating resources toward gold and other currencies. Their profound regard for this precious metal is discernible through their archival records asserting that the history of gold trading would be incomplete without the Rothschilds, and the history of the Rothschilds would be very different without gold. Engaging in physical gold investment presents multiple advantages. It represents a tangible asset that offers ease of acquisition and sale, serving as a dependable reservoir of value with swift liquidity potential. But in pursuing this endeavor, it's essential to contemplate the possible drawbacks associated with procuring physical gold, enabling you to make an educated decision aligned with your circumstances. Fifth, cash and cash equivalents. A significant portion of the affluent population embraces prudence in handling their wealth. They recognize that excessive spending can significantly erode their wealth. However, it's essential to note that while they may willingly invest in essential needs and indulge in occasional luxuries, they also allocate a significant amount of their wealth to cash or easily convertible cash equivalents. What are cash equivalents? They are securities intentionally structured for short-term investments. With strong credit ratings, they can be swiftly converted into cash. Cash equivalents include treasury bills, bank certificates of deposit, commercial paper, and money market mutual funds. These assets often feature short maturities and thrive in highly liquid markets, simplifying buyer or seller interactions. They also tend to be regarded as secure investments. Warren Buffett, the renowned CEO of Berkshire Hathaway and a preeminent figure in the investment world, favors a portfolio brimming with money market accounts and treasury bills. Treasury bills are short-term notes the US government releases at a discount to procure funds. When sold, the variance between the face value and the selling price translates to profit. One noteworthy advantage of engaging in treasury bill investments is their remarkably low-risk profile. These securities enjoy the backing of the government, imparting a high degree of assurance that the initial investment remains secure, thereby alleviating concerns about capital loss. Moreover, treasury bills can be acquired in smaller increments, rendering them more accessible to individuals with limited investment funds. Even with a modest sum, like $1,000, Selecting a treasury bill over conventional savings account can yield more returns on your investment. Sixth, private equity and hedge funds. These investment avenues are associated with the securities and trading markets. Although they are not technically similar, they are prominent instruments within the purview of billionaires who possess the means to engage in substantial investments and take higher risks. Such individuals are typically recognized as accredited investors. For those unfamiliar with investing or the financial domain, the term hedge fund is a specialized investment vehicle managed by a team of experts to optimize returns for investors. Typically structured as limited liability companies or limited partnerships, hedge funds can allocate resources across an array of assets such as stocks, bonds, futures, options, real estate, commodities, currencies, and an extensive assortment of derivatives, including delta-neutral investing and collateralized debt obligations. Meanwhile, private equity revolves around trading within privately owned businesses, intending to optimize profitability. Both private equity and hedge funds demand a substantial capital outlay, rendering them inaccessible to most investors. Hi! We hope that watching this video was interesting and that you learned something valuable. If you enjoyed it, please hit the notification button, like, subscribe, and watch more of our videos. Also, don't forget to share your comments in the comments section below. This is Finance Sense, helping you stay current on all the most recent changes in the financial markets and economy. Stay safe and look out for the next video.